Turns out toxic loans are still clogging bank balance sheets. According to Bloomberg exclusive data, more than 150 publicly traded lenders own non-performing loans, and those loans make up 5% or more of their total holdings. Could we be on the brink of more bank failures? Ari Levy has been covering this story for Bloomberg News. He joins us from our bureau in San Francisco, and it looks like a San Francisco kind of day. Ari, thanks so much for joining us. And what's the significance of non-performing loans, particularly when they exceed 5%?
Yeah, well, Mark, as you know, banks make money on the spread between their borrowing costs and their lending costs. So if they are, if loans are out there and they're not performing, that means that the interest rate isn't paying. They're not making any money off those loans. On top of that, the actual principal of the loan is often not paying,
right.
And so they're not making the profit that comes from the interest. They're not actually getting anything from the principal, so that becomes a loss. So you have these losses piling up, and then you also have to have the capital on your balance sheets to fund the asset, regardless of whether or not that loan is performing. So you're not getting capital. You have to raise capital, and as we know, capital is very difficult to come by in this market.
Well, why are there so many banks at that level right now?
Well, over the last 7 to 9 months or so, what you've really seen is the mortgage crisis from the past 2 years has spilled into commercial real estate. Commercial real estate loans the defaults in commercial real estate loans have been surging. And so banks that loaded up on commercial real estate loans over the past 5 to 10 years, many of those were regional and community banks. And those are much bigger loans than a mortgage. So as those start to pile up, it doesn't take very many for a bank that, say, has 50 to 60% of its assets wrapped up in commercial real estate loans.
Right.
It doesn't take very long for that to hit the bottom line very hard.
Ari, what are regulators doing to prepare for what's expected to be a wave of bank failures at both public and private institutions?
Well, for one, they're closing banks at a fairly rapid pace right now. We're up to 72 this year. That's the highest since the S&L crisis, and we're at a pace of about 4 to 5 a week. There are also a number of banks are on cease and desist right now, so they're not able to do new lending. They have to decrease their asset base. They have to stop paying dividends. They really have to try and get their balance sheets in order. And so that's what the FDIC is doing on one hand. On the other hand, they've already increased the fee that banks pay, the special assessment fee that banks pay, and they're probably going to do it one more time this year. So they're going to try and build that insurance fund as failures pick up.
Ari, we have 30 seconds. What can banks do to survive if they're at 5% or more?
Well, the first thing is they want to hope for an economy to turn around, so a lot of those loans that aren't paying can potentially start to pay. They want to maximize the value that they get on the assets they try and sell, so they can minimize the losses. And they want to hope that the stimulus continues to kick in. The government continues to buy some of these bad loans, and they get some exterior help.
Ari Levy joining us from San Francisco talking banks. Ari, thanks.